Okay, good afternoon. The noon whistle has blown here in beautiful, sunny downtown West Bend, Wisconsin. So we'll kick things off. Mike Rush is my name with Total Farm Marketing. Glad to have you in attendance today. It looks like we have quite a few signing in, which is great. This is always a busy time of the year regardless. So it's good to see a number of you producers attending today's meeting. Obviously, the weather the past couple of weeks has kind of maybe put a hold on things, but with the weather we're seeing this week so far, my guess is we'll be making some headway in the fields sooner than later. All right, thanks for taking time. As always, every month we host one of these webinars to recap the latest WASDE report data and just give a little bit of insight and details to those numbers. And we'll talk about some of those specific findings in those numbers and relate them back to some usable ideas and even take a look at some of the charts for a few pointers on some areas to be making some decisions. So I'll try to keep this fairly tight, the next 30 to 40 minutes. Towards the end, before we wrap up, I will take some questions. So on your Zoom toolbar, as always, there's the Q&A. Use the Q&A feature versus the chat feature. So under the Q&A, you can type in any questions as we're going here. They'll be queued up for me at the end, and I'll get to as many of those as I can. And we'll talk about a few other things as well too. So we'll get things rolling. Also too, if after today's webinar, there's additional ideas for special topic webinars, excuse me, besides our normal WASDE report wrap-up, certainly reach out. Let us know what you might have interest in hearing about, because chances are if you do, so do other producers. So if there's specific topics or other areas to cover, let us know. We'll do our best to provide some content and education. All right, let me stop my screen, my video here, and we'll jump into things. All right. So first, before we talk about anything specific, I have to show the disclaimer. Obviously, as we're talking about futures price movement and any type of trading tools, you need to be aware that there is exposure. There's exposure to risk of losing, and there's also exposure to the potential of benefiting and looking for opportunity, which are the same risks and rewards that you have when it comes to farming. So it's nothing new, but please be advised. All right, a quick highlight wrap-up of last week's report for the 2021-2022 period. Corn ending stocks were pretty much left unchanged from the March at that 1.44 billion bushels. Soybean ending stocks decreased to 260 million bushels from the 285 that was in the March report. World corn stocks increased the 4.5 million tons, up to 304.5 million tons total, and world soybean ending stocks decreased about 0.4 million tons. So nothing huge in that report. It should be noted too that the USDA in this report, in this April report, did make an attempt to assess the ongoing short-term supply-demand impacts from the Russia-Ukraine conflict. So as they're worked their numbers, that was at least kind of an overarching theme or focus. And obviously, as time goes on, we'll get more of that detail as more official numbers and time goes on. Anyway, so Friday, though, a couple things to mention. Both the corn and soybean markets began the session trading higher into the report. Corn initially had a bit of a negative reaction, but held support and finished 11 cents higher on the day on Friday. Soybeans had a more muted initial reaction to the report, but like corn, soybeans also finished the day strong with gains of about 43.5 cents. U.S. corn U.S. bean carryout came in slightly below expectations. Expectations were 262. Well, the world bean stocks came in below the 88.8 million bushel expectations. The corn side carryout came in slightly above expectations. The expectations were 1.415, and the world stock numbers came in slightly above expectations, which the expectations were 300.91 million tons. So that's a quick overall summary. I'm sure most of you had a chance to digest that last week when it came out. That's just kind of our starting spot. So let me talk just a little bit about the weather, then we'll get into some of the specific data on the corn and soybeans. So with the report behind us, of course, now weather will become the feature. Prior to the Russia-Ukraine situation, the story for the past year for many of us was dryness and the threat of dryness across much of the western corn belt and in northern plains. So looking at this chart, the left side, the left panel, the left chart, is about a year ago, looking at a year ago situation compared to the right side where we're currently at. So you'll see the southern plains has experienced some more dryness, while the Dakotas have seen some relief. However, Iowa, Illinois, and southern Wisconsin have also seen some additional dryness. So it's still building, still pending. Obviously, the last week has brought a little bit of moisture, but I don't think we've come anywhere close to replacing subsoil. There has been some calls in recent weeks for the western corn belt to see some additional dryness this year versus the eastern corn belt. And it'll be interesting also to see how the effects of the La Nina will be seen as we move through summer months, as the current La Nina is estimated to have about a 53% chance of continuing through August, mid or June through August timeframe. That's where it's looking to continue. And it's this La Nina pattern that has often been associated with the warmer, drier conditions in the southern plains versus some cooler, wetter conditions in the more northern regions. So we'll see how this shakes out. Much of the focus, of course, over the last few months has been South American weather and the dryness in the southern plains. But as we move into planting season here in the U.S., the focus will, now shift to U.S. weather. This map looks at precipitation in the United States for the 30-day period from March 8th to April 8th. And you can see on this map that much of the eastern and southern U.S. have received quite a bit of precipitation, which has led some people now to voice concerns about possible late planting in parts of the South. So that'll continue to be an ongoing discussion each week with the planting progress. One last look at the weather. Here we look at the two-week precipitation and temperature outlook for the U.S. So for the next couple of weeks, it does look like much of the nation will experience lower than normal temperatures. Well, California and southern Florida will experience normal to above normal temps. So we do seem to be in a little bit of a below normal temp pattern. As far as precipitation is concerned, it looks like most of the key growing areas will receive normal precipitation in the near term, with the Dakotas and Minnesota maybe being slightly below. All right, let's go into a bit of market overview. Now, as you know, of course, there's a lot of information out there to look at the data and bring in supply-demand picture. Here at Total Farm Marketing, as a team, we look at over 40 different key indicators of market momentum and strength and overall positioning each week. So there's a lot of data to pour through and a lot of studies based on that. For the sake, of course, of these webinars, we're going to talk a little more high level and just cover a few pieces that we look at to give maybe a more kind of consistent picture. But again, if there's specific questions that come up or need for more specific or a deeper drill down in any one of these, again, put a question in the Q&A box, or at the end, I'll put my email address up and phone number. You can certainly reach out if you have additional questions or interest in some of that data. Starting with corn. Again, staying consistent if you've been on board for future webinars, but we always start by looking at kind of the yearly range, contract trading range for the December corn futures. So for quite a few years, looking at this chart from 2014 up to about 2020, we saw the market really stay in a rather tight range, tight high to low trading range, meaning that if you're kind of mis-selling near the top of the market, you didn't really miss a ton of opportunity. There wasn't a really wide range. Now, recently, of course, with the, aid from the recent conflict between Russia and Ukraine, December corn has continued to trade to new highs and has exceeded last year's high, which was, 638, I think. It's still early in the year. So in the big picture, there's a lot that can happen, both positive and negative. But of course, we appear to be in a time of this high volatility. And we've seen that in the past. That 2008 to 2014 period was a range of higher volatility. But if you're thinking generally speaking, taking out some of these wider ranges and a little bit of the anomalies, the standard trading range from December corn from in this chart here, 1990 up through now, it really has been around $1 high to low. So when you start seeing these extended ranges, of course, it's bringing a lot more opportunity. But also the big picture is these periods don't tend to stay around forever. So going back into more of a subdued lower volatility pattern, is probably somewhat to be expected going forward. Not saying immediately, but in the near future that we'll probably start to see things level out. This chart looks at corn yield and the trend line. So each dot is a that year's predict or estimated yield and obviously finalized yield from the USDA. And then of course the dashed line is the trend line. Since 2014, production has really been above trend line until 2019 when we had a fall off due to that late planting and flooding that we had. As a reminder, 2020, when yields were projected to be at 181.5, that was in the August, the yield number kind of fell steadily through the remainder of that year, and we're down about 9.8 bushels to settle at the 172 bushel per acre average. That was the biggest reduction in the USDA had registered since the 2010 period when yields fell about 12.4 bushels per acre from August to January. So this year, the final yield numbers were issued in the January report, I should say last year, right? We know that wrapped in at 177. So going forward now, start to have a look and kind of have an idea of where this market is expected to be at trend line, which will be right around that 177 period. There's a couple of slides. I'll show you a little bit more of a sliding scale or looking at what type of sensitivity we can expect with changing yields going through this year as we uncover more of this year's situation. Looking at corn carryout and then stocks to usage. So the bars on this chart would be the corn carryout that the USDA put out, and then the red line, and of course, that would be the right-hand scale. That's the stocks to usage ratio. And that's just dividing ending stocks by the total usage, which just gives a better feel for the strength of demand. Looking at this in chronological order, you can see that the last 2 years, so 2021 and now looking at where, I should say last year, 2020, 2021, and now looking at the 2021, 2022, we're expected to see a slight increase based on current estimates, which again can change quite a bit in overall ending stocks, and obviously a little bit of a push up in stocks to usage. Now, keep in mind for corn specifically, stocks usage ratio below 10% is what's considered bullish when we're seeing really tight supplies. And when you're above 15%, that's where it gets to be a bit more burdensome or bearish. So when we're trading right around 10%, that's kind of that, we're just starting into that very bullish period. Now we're slightly below, with this year expected to come back up just underneath 10%. So still, adequate supplies. We're not running out, but certainly on the tighter end of historical levels. So it's a concern point. We're in that bullish period, and obviously the price is reflecting that. Looking at the world corn carryout, a little bit of a different picture. We're seeing the last year and what expected this year to be, decent in terms of overall supply. Yet, look at the stocks to usage ratio. That has been continuing to fall. So even though we're seeing higher stocks on the world carryout level, the demand side is really kind of absorbing that. So we needed to see that to satisfy demand. So again, not the tightest picture, but certainly with stocks to usage ratio kind of staying downtrend and now a little bit stagnant, it still has the world's attention. So keep an eye on that going forward, especially as we look to adjust this year's level. Exports, a quick look at the export picture. The thick black line you see right here, that is corn commitments for export for the 2021-2022 marketing year, which started back in September of 2020. Now, exports are forecasted to be lower than last year's record number, which came in at 2.5 billion bushels. In the red here. So sales for new crop corn had a big jump in May, but then have been mostly quiet before ramping up again this past fall. China was a big part of the nearly vertical moves in sales charted from May. They've been sporadic buyers over the last year, booking large amounts of corn and soybeans in short periods of time, and then going quiet for extended periods of time. So like always, the answer is China. What will happen with prices? Well, what does China do? As you look at this, just keep in mind that exports and China's buying has an impact on corn. It is a little bit more vital to the soybean market, which we'll look at in a minute. So far, decent levels, decent pace, not quite as high as we have been, but certainly above the last couple of year average. I mean, outside of last year, but the previous years before that. So decent overall pace, and obviously with the Russian-Ukraine thing, we'll see how that factors out going forward. So here's a piece of data and analytics that we created just to get a bit of sensitivity around the market situation with as far as stocks to usage, well, ending stocks and stocks to usage. So we just build in what the USDA is giving us. So starting over here on the right-hand side, we build in where, beginning stocks or ending stocks one year coming into the next year. And we factor in what the USDA is predicting for overall demand, and then build the chart based on what's expected to be planted acres and where trendline yield, which this year comes in at 181, what that would give us for ending stocks based on demand, and then of course convert it to stocks to usage. So 9% stocks to usage is where things are pegged this year with the current data. Now, a lot can change yet. So what we do to look at sensitivity is just build some flexibility around changing acres plus or minus and changing yield plus or minus. And based on the current USDA demand situation, what does that give us for a change in ending stocks as we wrap up this year, and of course then stocks to usage. So this helps us look at this and say, if we end up seeing things, whether it be a strong yield, maybe a few more acres, and we see things push up to that 10 or 11% stocks to usage ratio, what does that mean compared to where we're currently at now, or projected to be at 9? Or what if things get a little bit worse? We have a few less acres or a little bit weaker yield. What does this mean? What does a 6.3% stocks to usage mean for price based on history? So a year like this with fairly tight stocks, again, nobody's running out, but what could happen, what worst case scenario could happen, doesn't take a heck of a lot of change in either acres adjustment or slightly lower yield. I mean, a 177 yield would not be a disaster of a crop, but certainly would look at dropping and lowering our stocks usage ratio, which in itself would be fairly friendly and bullish to the market. So it helps give us a sensitivity on the market. Now, this becomes more important the later we get into the year when more of the unknowns are taken out, when we actually do have a valid planting acres number, and then start to have a better picture for summer weather. So this is where it all starts. We have to have some idea of what's expected, and then what's that sensitivity around some minor changes to the current predictions. Taking that data, then we can look at creating some, price scenarios or price ranges where the market would more likely be trading in. And basically all we do is we take, and this is looking at the last 16 or so years, we just take the stocks to usage ratio from the August through December data of each one of these years and plot that on a map along with the price, the December futures price the market was trading at that time. And we get this scattergram. We can snap a best fit line through that and have a bit of an average. Now, the shaded area would kind of give us an idea of what type of range we could expect to see December corn futures trading in based on the current data that was put out on Friday. As you can see, this is telling us, hey, the high end of the range would be just below $6. The low end of the trading range should be just about $4. Obviously, where we're currently trading right now, in the $7 range, we're quite a bit above the upper end of what would be a normal expected range with this given supply demand situation. Obviously, there's a lot more at stake here with weather concerns, with war concerns, with South America concerns. So there's quite a bit of premium put in this market. That being said, making some sale decisions up in this range certainly would be encouraged, because we are technically above where the market would normally be trading at. So there's other factors at play. Not saying you shoot both barrels right now, but getting a jump on things and taking advantage of the current above range price structure is certainly worth considering. Taking a look at the managed money position, the fund, the investment position relative to corn price. So the shaded areas above or below zero is the number of positions the funds on a weekly level are holding either long above or short below zero, the market collectively as a whole. And then, of course, the yellow line is the current price, weekly price of corn in this example. What you can see, you think of it a little bit about like momentum trading. When prices are going lower, the funds, whether they've started the trend or not, they tend to follow it and keep selling into the market and adding more short positions, and thus the price keeps dropping, and vice versa. When the market starts reversing higher, whether it be because the funds start to reposition or whatnot, they continue to add into the strength of the market. So you get a bit of that momentum swing in the market. What's important to note, though, is you look back here for the last number of months, back from May in 2020, they've really just kind of been building a long position and holding on to it. Over recent years, a much longer and higher long pattern than we've seen. Now, we've seen it back in other bull market periods, so it's not like it hasn't happened before, but in the recent years, we have not seen them stay this long, the market, to this aggressive of a position. So this is important. We cannot outguess what the funds are going to do, but we certainly can monitor week to week. Are we seeing them start to change their overall position? And that gives us one of the leading indicators into market momentum and timing of when to be repositioning. Now, the age-old saying is, hey, you'd rather be stepping onto a moving train rather than in front of it, and this helps us with our recommendations do just that. Let's not be getting ready to make some major sale decisions when the funds are getting ready to get long or add length to their position, and vice versa. So keeping an eye on this on a weekly level can certainly be beneficial, just with some timing and, again, overall momentum potential in the market. Okay, let's just take a peek at a few charts on corn. I just gotta grab my chart here. This is a daily front month corn chart as of last week, Friday, the 8th. And goes back about a year, about to mid-May of last year. A couple takeaways. Obviously, volatility has eased off a bit as the market has consolidated around that 750, 760 area. We're seeing this kind of sideways pattern here. Prices are attractive. I know inputs are higher, but the 750 level is certainly attractive, especially if we're looking at last year's crop in storage yet. The markets have steadily rallied a little bit off of key support. Looking all the way through here, even since the beginning of the year, we're just kind of seeing this market continue to kind of rally off some of the moving average support lines. The red line down here is the 200-day moving average, and you can see, pretty much through majority of end of last year into now, we've just kind of been moving ourselves away from that and staying above the other moving averages as well. Some key levels of support would be found between that 714 level, that was the March low, and then 705, which is the 50-day moving average. So that's just some key areas of support. If we end up breaking below that, we have to be a little concerned something major is changing. Obviously, buyers have been in control as of late, but with already a large long position the funds are holding, things can change in a hurry. And if you look back at that chart with the fund positioned, they're kind of near some of the max levels they've been long corn futures. So not saying things couldn't change, they couldn't add more length, but we are at some of those levels where maybe they're holding tight and would need, another round of fresh bullish news to really try to get us to push above that. So as you guys know, the markets can move pretty fast, and we say this often. Find some levels, set some trigger points above this market that you're comfortable making sales at, and even be prepared if things start setting back to sell before a major break. But find some levels and be incremental about it. Small sales, but chip away at some of this price structure. In this type of environment, large moves can happen very fast, and we'd hate to see you be busy in the fields here in the next month or two and other tasks that need to be done as summer weather's upon us, and miss out on some major changes in the marketplace. So think strategically now, set some targets. Looking at the next picture, this is a longer term view, looking at monthly corn. So this each bar is the range of a month of corn being traded back to about 2007 on this chart. Last May, which is this hump right here, was the highest we've seen since 2013 on front month corn. Now, of course, recently we broke above that. If prices were to fall back and start to settle back at all, that 610 area, this black line here, that would kind of be a major level of support here in the near term. So staying between 5 and 5, and then if we break that, of course, falling back down between $5 and $5.50 would be that next major area of support. So we have a lot of upward momentum right now, which is great. If we start to run out of steam, starting to expect a pullback. If we get down to this level, we should be able to find some fairly solid support until we know more about this crop. However, if things break back down below that, now we're targeting something down here where these moving averages have combined. So be cautious. The downside on corn could be pretty severe if we run out of bullish news. It's early in the year yet, so be optimistic, but also be smart and be prepared. Now, it'd be logical to expect this market to maybe retest the 2012 highs and maybe beyond, and that we could certainly see that happen if we continue to get some bullish momentum. And one thing to mention, taking this look now, this is just a much longer, broader look, just looking at December corn on a continuous monthly level. Looking back over time, two things to mention here. One is you can see the market has spent a lot of time in these sideways patterns, these troughs of price, or sideways patterns kind of stagnant the price. And every so often we get these breakouts where we get pretty aggressive and we move. But as you notice, we don't stay up there forever, right? There's kind of these V-top formations. This is the period here between 2010 and 2013 or so, where we had a couple of years in a row of lower yields, and that helped kind of spark a multi-year run. But generally speaking, where this top line is, that's roughly $5. Historically, we don't spend great deals of time. We haven't spent great deals of time above $5. So again, not saying you should get aggressive and sell everything now by any means, but be mindful that when this thing does end, it typically doesn't just linger up, $6, $7 for a long time. Things can actually become pretty severe and pretty volatile to the downside. So keep that in mind. Now, if one is wondering, where the market may find a top, just consider this. Years ago, our founder, Scott Stewart, did a lot of research and concluded that when commodity markets of all kinds, any commodity market, break through into new highs, it is common for that next level of price discovery to be the upside of about 140% of the previous high. Now, a number of years ago, that meant corn could go to $7, and it did back in 2008. I think in June of 2008, we topped out at $7.99 and a quarter on the front month contract, and that was about 140% move above its high before that. In August of 2012, I'm sorry, back up a sec. So looking at that, then with the all-time high coming in August of 2012 of 843 3/4. A quick calculation from that high, looking at 140% retracement, would be about $12. So is it possible we could see $12 corn in this given environment if we take out those highs from 2012? Yes, it is, because we've seen that type of move in the past. Are we predicting that's going to happen? No, we're not predicting it. But again, if we keep getting bullish news and this crop doesn't get in the ground, or there's weather concerns, and that's that next wave of bullish news, you could expect to see some pretty aggressive moves. is a prime environment where producers need to be very flexible with the tools they're using to manage risk, but also manage opportunity. And being able to use some of those trade positions like options and option combinations to get yourself more flexible is certainly going to be, we feel is going to be needed in an environment like this. Okay, let's jump on to soybeans. Very similar story to corn. Looking at, oh, got a message here. Okay, looking at the trading range for November soybean futures, similar picture to corn. It's been relatively tight for about 7 years in a row, and then we started to get a breakout at the end of 2020, and now we have some extended ranges and overall higher price structure ranges. You look back where we started in 2021, almost $13 November futures with a range in excess of $2. Currently, November 22 beans are at that $14.95 mark, with a spike up to $15.55 on the initial reaction to the Ukraine war. So we are seeing some good overall range and volatility. Looking at trendline yields, going back a while, you can see since 2014, with that delayed planting period, we had a bit of a drag down in yield. In the 2019, we saw that setback after several years before that of higher than trend line. Now, keep in mind, though, especially compared to corn, the trend line yield for soybeans isn't quite as impressive, as producers really have only picked up about 10 bushels per acre in trend line yield over the last 20 years. But that also means that minor changes in conditions or weather can certainly cause a major change in that overall yield. The high point shown is at 2016, which was 51.9 bushels per acre, and this year, the 2021 yield came in at 51.4. So right up there in line with being close to record. Okay, looking at the U.S. bean carryout position, similar picture to what we saw with the corn. Now, in this case, in corn, it's 15% and 10% range stocks usage. In soybeans, if we get less than 5%, it's bullish and very tight supplies, and greater than 10%, we're normally in more of a bearish territory. The 2021-22 had fluctuated a bit the past few months and currently sits at that 5.8%, which is above last year's tight carryout, and which was down closer to at one point in time, down closer to 2.5, but it had come up over the year. Stocks used for the 2021, were very tight, and now we're a little bit more comfortable at that 5.8, which you look at the last 25 years, it's kind of low middle end of the range. But again, kind of a stagnant here in overall carryout, and stocks usage kind of flattening out. Now, China has been back in the market as a buyer, though much of their purchases have centered around the new crop. So we're seeing more of their shift to looking at new crop purchases, and they also began to make purchases from Brazil last winter as they began their harvest a bit early. South America is expected to have some harsh weather, had some harsh weather, and so we're still trying to sort through where that's going to come out and how much of that demand will find its way back to the U.S. But we are kind of in that window now where we're going to start to determine that, especially as we get into the fields. Whoop, sorry. World carryout levels. Beans are a global market, right? So the takeaway here is that we are kind of in a neutral to nearing bearish territory with the overall levels. But again, world stocks usage is still kind of on a bit of a decline. 25% is still comfortable on the large term scale, but we are seeing, this steadily kind of fall the last 2 years. So keeping an eye on that as we look at our production this year and how we add to the world carryout is going to be key. Looking at export commitments for the 2021-2022 marketing year, which again started back in September of 2020. The black bold line again is what we're looking at right now. The red line is also from last year, 2020, the 2020 picture, and here's where we're currently at as we're into this window. So again, early on, some good buying from China, then they kind of went quiet. Now we've been seeing some additional moves as we've been going forward. I mean, China accounts for about 60% of the world's soybean imports. So, lower crush margins may have curbed some of China's demand as of late, but they've recently been more active with the new crop purchases, like we mentioned. And, we'll just have to see how much of that we're going to gain from Brazil. I also mentioned this before, but exports on soybeans are a much bigger deal relative to corn, so this will be monitored closely week by week. Looking at the carryout projections like we did for corn and the stocks usage ratio for this year's crop, starting with USDA's baseline projections in the report, we've updated this to obviously reflect the planting intentions report from the end of March. So we're looking at 91 million acres, and obviously trend line would come in at 51.5. So that puts it about a 416 million bushel carryout, which is then a 9.2% stocks to usage ratio. And again, we can build some sensitivity around this to see what type of changes, good or bad, plus or minus, and the impact it's going to have on overall stocks usage ratio. Building in the current USDA levels of demand and carry-in. So, here's where we're carrying in, or where we carried out last year, and with this year's situation, we're expected to not quite double that, so 416 versus 260. Taking that and applying it to that price range analysis based on historic levels, that puts us, at a projected range of 10.5, I should say 11 on top and maybe 9 on the downside. And again, where current prices are at in the 14.5, 15 level for new crop, it's worth making some decisions to take advantage that we're above fair value given the current situation. Now, again, these numbers, just like corn, are going to change as planting and growing progresses, and we kind of sort out exactly how many acres and what other crops are buying for those acres. So a lot will change as we go forward. Managed money position on soybeans, similar picture to corn as well too. The funds have held a net long position for the greater part of the last 2 years. And we had a bit of a setback here towards the end of last year, and then halfway through last year, and then this build up. And as we're heading into this year, holding with about 160,000 contracts long, largely due to smaller South American crops. And of course, the export issues with the sunflower oil out of Ukraine. So a lot of volatility, and going forward, expect to see more of this. And with the funds, could certainly add some more length to their holdings in soybeans. Double-digit daily moves will not and have not really been out of the ordinary. So expect to see that continue until we know more about this year's crop. Taking a quick look at some of the chart activity on soybeans. This is the front month soybean contract going back about almost a year, going back to end of April last year. Market has had some volatility over the past few months, obviously. Soybeans traded below the 20-day moving average for the first time since mid-January, and then found support near the 50-day moving average and the February low of 1586. With the current fundamentals and overall world market concerns, it'd be logical for the market to test the March highs of 1736 and then the February high of 1765. Now, if not, and we start to set back, the initial support below this market is found near that 50-day moving average, so about 1628, and then again near the recent low of 1576. So we have, a little bit of downside just in some normal kind of flat market trading situation. Obviously, though, key support that would be near that 1540, and if we fall below that, there really isn't much to hold us together until we hit that 200-day moving average, which is right down at 1392. So there's quite a bit of air below here that if we get into that territory, there's not much to find support on until that moving average. Soybeans do appear to be struggling to continue higher currently. You know, and obviously there's some concern over future demand. If we do have this enough acre shift and kind of rebuild our carryout, those things can kind of be a bit of a stagnant situation for the soybean market. So obviously, again, a lot will play out as we make our way into planting this year. Here's a quick look at the monthly soybean chart. I guess just looking at this from the broader picture, similar picture to what we saw on the front month chart. You know, the setback, now this rebuild. Now we've seen soybeans, they've been higher for 11th in a row from the June 2020 lows, and then experienced a bit of a correction from May to November of 21. And then since then, we've had 3 big months of taking out last spring's high, largely due, of course, to the short crop in South America. So it appears that in the big picture, that $12 area, which is the highest from 2016, looks to be kind of the main solid level of support below this market if things start to break. Obviously, if we cannot sustain and hold this together, or things really start to become bearish, that $11.80 to $12 area is where things would kind of head to if we fail. Okay, so information, data, overview of what we're currently looking at. What do you do with all that information? How do you make that work for you? So to kind of wrap this up, the big picture is, over the years, almost 40 years ago when Scott Stewart started in the industry, he realized early on that the best approach for producers to use, and this is with analysis and understanding what producers have been doing, is we need to shift away from outlook and trying to outguess what's going to happen and start to be more strategic and build in strategies for the various situations that could arise. So we use that data, all that data we look at, rather than looking at it for an end-all be-all to make one decision. Let's use it to help define probabilities. What's more probable to happen in the short term, even in the mid or longer term, and also what's less probable. And then develop your plan A. Your plan A strategy, always based on what's the best, the highest probabilities. Let that be your plan A. But then immediately, always develop contingency plans. Have a plan B, a plan C, a plan D, even a plan E for all those low probability situations that could happen, because they do happen. Nothing will ever be 100%, so we have to be prepared for the what ifs. Make sure you're prepared for anything the market might throw at you. Here are just 4 key pillars of what a good overall revenue management approach should be based on: using more strategy, less outlook; helping manage your emotions, not just run with them. And truthfully speaking, when you do build a more math-based strategy and less outlook, it's much easier to manage those emotions. So those two kind of go together. The third one, focus more on managing your revenue and building a strong overall average price and being able to adjust what that looks like, the outcomes, by different strategies, rather than just focusing on one decision at a time. And the fourth one, here's a big one. That's just the old Boy Scout motto of always being prepared. We call it market scenario planning, but taking time now to lay out all the things that could happen in the market, all the potential moves, and just be prepared with different strategies of how you will handle that to balance out risk, but also balance opportunity. Okay, final disclaimer slide. And now, look at my Q&A box here. See what questions we have up. I don't see any. I guess nobody on this webinar had submitted anything. Feel free, use the Q&A box to submit a question quick if you want. But I had one question. Well, actually, it was a combined from several different producers over the last few weeks I've talked to. To wrap it up, I defined it this way: will we really plant more soybeans? and less corn this year, significantly. And obviously, there's a lot to be unfolded yet. We know input costs are high. The prediction is we will see that roughly 4% shift, right? I think corn acres were expected to be about 4% down from last year, and bean acres about 4% up from last year. So that's the shift that's expected. It is until we get more planting progression with planting, it's gonna be hard to tell. Obviously, input costs are a huge impact and a huge decision in this. We get that, we all know that. One of my colleagues, Brian Doherty, wrote a perspective last week, which I thought really answered some of these, or helped answer some of these questions, at least indirectly. If you guys want, and reach out to me, call me or shoot me an email, I can send you a copy of this. But generally speaking, the report, like I said, 4% lower on corn acres expected, 4% higher on bean acres expected. A lot of this, of course, was done when producers were just looking at that. Well, now we've seen other contracts like cotton, canola, milo, spring wheat. They've all seen contract high moves and are vying for acres. So there's a lot of competition out there. Corn is still very fuel intensive, and there's a demand for that. So let's look at this objectively. And the question is, will farmers, maybe switch back to corn as we start getting into planting here? Obviously, no one knows for sure, but think of it this way. Last week, soybean prices lost almost $1 in price, and corn rallied about 50 cents or a bit more. Obviously, time is going to be the biggest thing here as we move forward. It's going to take some time to really address, but the March report, the March 30th or the 31st report was an estimate, where when we get to the June acres report, we'll have a lot more accurate view and see what guys actually did. The point being is that when you take this estimate and guys are surveyed and they're just looking at input costs, yeah, it's easy to say we're going to see a switch. Well, now as some other markets have become more competitive, as there's been a little bit of a price adjustment in between the two, guys may still look to reconsider. But I guess the reason I say this is there's no good way to predict exactly where things will be, if there'll be this major shift or to what degree. But be prepared. Be prepared. Start setting some trigger points in this market, and with some sale targets, and chip away at some of the risk and exposure, and then position yourself for some opportunities is really going to be the thing. There's no way to quantify and outguess. We just need to be strategic and prepared for all potential scenarios. Okay, I think we're just a shade over time. Yep, 12:46. We'll wrap this up. There's my contact information. So again, if anybody has questions or need to ask more questions or want some more resources, reach out. Hey, I did get actually 2 questions pop up quick. If the war would end tomorrow, what would happen to the market? I'll just take time to answer that. Once again, no one knows. Although that is it's a huge uncertainty, not knowing if they'd still have enough time to produce enough crop, and what that means for the world economic picture. If the war did end tomorrow, my guess is it would take, at least initially, one of the bullish pieces out of the equation. But the caveat to that is, does it create then a different focus on the shift in production, that they won't be able to get enough production in place, and they still have issues with rebuilding their ports that have been damaged. That'll be the next wave to be thinking about. It's being talked about now to some degree already. So if the war ended tomorrow, there may be that initial kind of panic setback in the market, but I guess my personal view is it probably wouldn't necessarily mean an end all be all to this rally, because then the focus would be put on, well, is it feasible to still get product and crop moved out of that region? And, maybe more importantly, where does China sit with their export needs, and can South America fulfill that? So it takes one bullish peg out of the equation, but it probably opens the focus for the additional ones that are there. And that's the question, is, do those become front and center? So I can't give you a great answer other than, there's a lot around just the war itself. It's the impact that has had on being able to move crop out. One other question here. If I still have 2020 crop in the bin, should I start selling a little bit of my corn and soybeans? I can hold 22 in on-farm storage. Well, if you have old crop in the bin, I guess it depends on what percent is left and what you've averaged for a price on the rest of that old crop. Holding on to some gambling stocks, 5-10%, maybe 15, for, again, this $12 corn situation where things really we see that next major wave higher in the market. I'd never tell you not to do it, especially if financially you're sitting okay with what you've done on the rest of that crop. Then I think you have some ability to quote unquote gamble a little bit. And if you're comfortable with it, I mean, no one knows. There's certainly upside potential. So holding on to some gambling stocks isn't the worst idea. But yet, if you need the income, if selling now would greatly help bolster your average price for that old crop, then considering selling some certainly would make sense. Okay, we are out of time. Thank you all for attending. Thanks for sending some questions in. And again, reach out to me if I can be of assistance, answer any other questions, and pass along some information. All right, be well. Take care.